Amalgamated Appliances reported a 62% drop in first half headline earnings per share to 11 cents. Its revenue increased 23% to 6.4 billion, and that amidst economic growth challenges and reduced consumer spending. Alan Coward, who's the CEO of AMAP, joins us now to unpack the numbers. Thanks so much, Alan, for joining us today. As we can see, continuing with the momentum that you've set since the turnaround back to profit, to have all your targets been hit this time round with regards to revenue, profit, margins.
Alicia, great to be here. We're delighted with the results. So we achieved a 22% growth in revenue, as you said. We were firing in all the categories, operated well in Africa. All our different categories performed. We achieved market share, 2% growth in Russell Hobbs market share, organic growth in the new categories that we launched. So we were delighted. That filtered down to a 35.5% operating profit growth, and then a normalized, what we call normalized earnings per share growth of just over 16%. We had some non-trading items, non-recurring items, and that's what resulted in lower headline earnings.
So the restructuring process you've seen over the last couple of years really paying off and taking you to a position certainly that's made you attractive as an acquisition target. Bidvest having its sights keenly set on you, now acquiring 100% of the business. What does this mean for the business's strategy moving forward?
So first of all, if I can just update you on the Bidvest approach. So we were delighted with that. That's a big compliment to be approached by Brian and his executive team. And the shareholders will vote on the deal on the 12th of April. So the minority shareholders, we're sending a circular with all the details to all the shareholders, and they will then vote on the 12th. The board has reviewed the offer. They've had an independent expert look at AMAP, value AMAP, and the board is supportive of the bid from Bidvest. So I think, in knowing Brian and knowing the executive team, our chairman is David Cleesby. They looked at the strategy, and I think Brian will look for us to accelerate our strategy, bring the power and muscle and the intellectual capacity within Bidvest into AMAP and just drive it further, faster, quicker. And I think we will achieve good things together.
Within South Africa, but also out of South Africa's borders. So let's take a look at that Africa strategy because, when it comes to your Russell Hobbs consultancy agreement, that's really what you've been leveraging off to muscle your way through the rest of the continent so far.
Yeah, it's still early days in Africa. Africa, we hope, will be 8% of our business this year. So with the Russell Hobbs acquisition, we're busy talking to all the Russell Hobbs dealers. We're looking at the information that we're getting from the States and from Europe around the dealers, around the approach. They're giving us a lot of information at this stage. And we think that, and we know that the Russell Hobbs business will accelerate, and we can leverage that business with our other brands because people want the Russell Hobbs. And then we can introduce South African brands such as Pineware, Sultan, Tedelex, all those brands through to Africa.
Of course, your brands are good, better, best. They fall within that category, and so it leaves you targeting a very wide LSM group. What's your assessment of the current consumer market in Africa, but in South Africa more specifically?
So Africa trading is very tough at the moment. We see the categories in which we operate are flat. But the consumer at this time, every cent that they spend is very important to them. And they go to trusted brands. We use that word, trusted brands. They go back and they buy the brands that they've relied on, that know are going to work for them, they know they're going to get value for money from, and they know that there's not going to be problems with those brands. And as a result, we've seen an increase in Russell Hobbs. If I look at the same thing that's happened in Europe, in the UK, Russell Hobbs market shares also increased by 2%.
Where you're looking at reputation and credibility of these brands, how difficult is it to push higher prices through, increase your margins on that basis? Because something you've got to consider in a very big way is the kind of weakness that's filtered through to the rand, because that means imported inflation, that means your imported products are coming to you at a more expensive price tag.
Look, we have a lot of challenges around the costs. We have challenges with the exchange rate, we have the petrol price, we have the potential of the toll roads going up, we have the electricity prices going up for our local manufacturers, so we have all these challenges. But it's important for us to make a profit. Because if we make a profit, we can continue investing in manufacture, in tooling and equipment, in new products, in innovation. So you need to get the balance right. And it's a difficult balance. You never get it quite right. People always look and say you can do things better, prices more competitive. So our strategy is to have the lowest cost in the market with the right prices that are good value for money for the consumer.
A lot of this growth that you've seen and the brands you've been able to put out there as a result of you having been pretty acquisitive as well. Just how acquisitive do you plan to be moving forward?
We like to do one acquisition a year. We've just done a small one. We've acquired Metalex, which is bakeware and braai products. It was about a 6 or 7 million acquisition with about 30-40 million rands worth of turnover. But the potential for that is really high. Bakeware products coming out of China. We will be in opposition to local manufacture, and we see a market in Europe for that. So there's some exciting things that come out of the small acquisitions.
Well, what do you see that doing for your muscle right now? I mean, how aggressive a contender are you in the current market space, and how aggressively are you managing to steal market share?
We've looked at the size, the economies of scale, and we're running at about 1.2 billion. We think for us to get the absolute opportune size is somewhere between 2.5 billion rand. That means we get more stuff on the truck, we get everything on one invoice, we have a lower cost of operating, so it's better for the consumer, it's better for the retailer. So we're continuing over the next 5 or 6 years. We would like to see one acquisition a year.